Welcome to Not Milk Never Milk. Subscribe if you're lactose intolerant.
You start by naming the asset and your objective: income, hedge, or directional profit. Once done, choose a time frame and set clear risk limits in dollars or percent so you know loss tolerance. Then decide whether you expect the price to rise or fall and pick expiration and strike width that reflect how confident you are. Make sure to size position to risk tolerance and confirm margin and buying power before placing any orders. You now construct the position. Buy calls when bullish or buy puts when bearish for defined loss. Sell options to collect premium if you accept margin. Once chosen, check delta and implied volatility to match probability. Place a limit order rather than market, set time in force and size, and verify price against the bid-ask spread. After submitting, watch fills and partial fills. If not filled, adjust limits slightly or split into smaller orders, while monitoring fees and margin impact. You finish by defining clear exit rules, a profit target, a loss stop, and rules for rolling expirations or closing early. Once position lives, monitor implied volatility, theta, and the underlying's movement. Make adjustments like converting to a spread to reduce risk. If an order won't execute, make sure your limit reflects the market, then widen it slightly or use a multi-leg order to guarantee leg fills. For broken fills or margin shortfall, contact your broker promptly to resolve.
Thanks for watching. If this was helpful, leave a like and consider subscribing. See you next time.